Welcome back to the Deep Dive. Today, we are wrestling with, I think, one of the most fascinating companies on the market right now. Roblox Corporation, ticker RBLX.
It's the ultimate riddle for analysts. You have this platform that is, just an operational triumph. It's cementing its place as a social utility, and the network effects are accelerating at this blistering pace.
But then you look at the financials.
And if you just glance at the income statement, it screams money pit. We're looking at a company that is right at a critical inflection point here in early 2026.
And that's the central tension we really have to resolve for you today. Roblox is, on one hand, this incredible success story, but on the other, it's a financial enigma. And at its current share price of around $80.95, the market is placing this enormous bet on its future.
Exactly. So our mission is to filter out the noise. We have to look past the huge gap net losses and figure out what expectations are truly embedded in that stock price.
And, of course, to see if any part of the deep value filter can even apply here.
Right. We need to follow the cash, not the accounting loss. This is a deep dive into that paradox of profit and, well, what the market expects to be perfection.
Okay, let's start with the operational blueprint. I think it's crucial for people to understand that Roblox doesn't really see itself as a game company, even though that's how most of us think of it.
No, not at all. Their corporate DNA, it frames them as a social utility that's focused on human co-experience.
And that goes way back, right? Back to its origins.
It goes right back to their roots in educational physics software, a company called Knowledge Revolution. The whole idea was about creating these persistent, shared virtual spaces, not just, churning out the next hit game. That distinction is key.
And that explains their technological moat. Because unlike a traditional game publisher that might outsource development or use third-party cloud hosting, Roblox went the other way.
Completely the other way. Extreme vertical integration. And it's fascinating how deliberate that strategy is. They control everything.
What do you mean by everything?
The proprietary Lua-based development environment, Roblox Studio, the unified client that runs everywhere, mobile, console, PC, and most importantly, the network itself.
Tell us more about that network piece, the Roblox cloud. Why on earth would they build their own data centers instead of just using AWS or Microsoft Azure like everyone else?
Margin expansion, pure and simple. They built this hybrid edge data center network.
The Roblox cloud.
The Roblox cloud, exactly. They handle the really low latency multiplayer experiences themselves. Now, they still use public clouds for some things, but building their own infrastructure lets them serve millions of simultaneous sessions at a much lower marginal cost over time.
This is strategic defense.
It is. It's their defense against rising infrastructure costs, and it gives them total control over the user experience globally.
And we saw this operational strength just explode in Q3 2025. That was a monster quarter that shattered all expectations.
The scale was just incredible. Daily active users, or DAUs, they crossed that huge psychological threshold of 150 million. They hit 151.5 million.
And the money, the bookings, the actual cash they collected, surged 70% year over year to $1.92 billion.
But here's where it gets really interesting for the long-term story. The demographic shift.
Aging up story.
Exactly. The data shows the 13 and older cohort grew 89% year over year. That is significantly faster than their traditional core demographic of, 9 to 12-year-olds.
And you called this shift the fundamental precursor to future high-margin revenue. Why is that so important?
Because it turns their audience into a compliant, addressable market for the highest valued digital commodity there is, advertising. A platform that's mostly kids, you can't legally target them with high-value ads, but a platform with a rapidly aging majority adult audience, that unlocks the sleeping giant of advertising revenue. And that revenue carries extremely high margins.
So on one hand, staggering growth. On the other, these huge red numbers on the income statement. A company that collects nearly $2 billion in cash bookings reports a net loss of over $250 million. Let's solve that paradox.
This is what we call the accounting anomaly. And it's driven entirely by how U.S. GAAP rules treat virtual currency, in this case, Robux.
So when a user buys Robux, Roblox gets the cash right away. That's the booking.
Correct. The $1.92 billion. Cash in hand. But GAAP requires them to treat that money like a gift card or an airline ticket. You haven't used the service yet.
So they can't count it as revenue.
They can't record it as revenue until that Robux is actually spent, or until they figure the user isn't coming back. So they have to defer it over the estimated average lifetime of a paying user.
Which is how long?
They estimate it at 27 months.
Okay, so let me get this straight. If I buy $27 of Robux today, Roblox has my cash, but they can only recognize $1 of that as GAAP revenue this month.
That's the mechanism, precisely. And during a period of hypergrowth, like we're seeing, this creates a massive and constantly growing deferred revenue liability on the balance sheet. As of Q3 2025, that liability was $5.69 billion.
That sounds bad. A $5.7 billion liability.
Yeah. It sounds alarming, but the key is that this liability is non-cash. Roblox doesn't owe anyone cash back. It owes the service, the Robux that have already been paid for.
It's a liability that will eventually just turn into revenue.
Exactly, without any corresponding cash flow. It's the opposite of a traditional liability like debt. It actually means the company is structurally succeeding.
So we cannot trust the net loss figure at all. What is the true measure of their health?
We have to follow the cash trail. That means focusing on operating cash flow, or OCF. In Q3 2025, OCF hit $546.2 million.
121% increase year over year.
That single number confirms the business is a spectacular cash-generating machine. And you have to remember, the net loss is also dramatically inflated by stock-based comp, which is a non-cash expense that gets added back.
This complexity means Roblox jest. It completely baffles traditional valuation. So let's turn to our deep value check. Does this platform fit the principles of Benjamin Graham?
You know, it's really the poster child for what happens when a business's value resides entirely in intangible assets. If you apply the Graham screening matrix, Roblox fails every single quantitative filter.
Walk us through those failures.
Well, first off, negative earnings, so the price-to-earnings ratio is useless. But the most important failure for a deep value check is price to book. Because of their huge accumulated deficit, over $4 billion in historical losses, their shareholder equity is negligible, sometimes negative.
Which makes the price to book ratio
astronomical. It's currently trading at about 139 times book value.
And what does that practically mean for a deep value investor?
It means there is zero asset protection. Graham investors buy assets at a discount. If Roblox's platform just falters tomorrow, there's nothing there. No factories, no inventory to liquidate that would protect your investment.
So it's the antithesis of a deep value stock.
The complete antithesis.
Yeah.
Its valuation is purely forward-looking. It's all about growth.
And we saw market signals that reflect this caution,
Right.
even from sophisticated players. The CEO, David Baszucki, selling over $6 million in stock.
And Value Act Capital, an institution that typically looks for undervalued companies, cut its stake by almost 10%. Insiders and value-oriented funds are trimming their exposure at these levels.
Which is a strong indicator that the smart money thinks the current price already has a lot of optimism baked in.
A whole lot of optimism.
Which brings us to the ultimate question. Since the traditional metrics fail, we have to look at future cash flows. What is the market actually pricing in at $80.95 a share?
Okay, so we ran a comprehensive discounted cash flow, or DCF, model. We used a really demanding hurdle rate, a weighted average cost of capital, a WACC, of 12.5%.
Why so high?
Because the stock is incredibly volatile. It has a high beta of 1.62, so we're penalizing those future cash flows pretty severely for the risk involved.
And what did that base case model tell you the company is intrinsically worth?
Our base case intrinsic share price calculated to $56.55.
Wow. That's a huge difference. So what does the current $81 price imply the market actually expects?
It implies what we call a blue sky scenario. The stock is trading 43% higher than our intrinsic value. That demands two things. First, sustained annual bookings growth of 25% or more for a decade.
And second?
And second, free cash flow margins hitting 35%. And you have to understand, 35% margins. That is rarefied air. That's like Google or Meta in their prime. It's a massive, massive ask.
That required level of perfection makes the risks here seem truly precarious. Let's talk about the first major drag on those margins.
What you've called the safety tax.
Right. The child safety crisis has moved from just a PR problem to a permanent operational constraint. The sources we looked at highlighted the 764 Predator Network and the state-level lawsuits that followed in places like Oklahoma and Louisiana.
And this forces management to spend a lot more on trust and safety.
Aggressively. And that's why we call it a tax. It's an accelerating, permanent drag on margins.
Yeah.
It's the cost of their license to operate.
They can't afford another scandal. Not at all. So every dollar they have to spend on moderators, on AI detection, on reporting, that's a dollar that cannot flow to the bottom line. It directly compresses the operating leverage that the 81-1 valuation desperately needs to be true.
And on top of that internal risk, there's a major geopolitical risk tied to China.
This is a risk that could wipe out a huge chunk of value overnight. Roblox has a joint venture in China with an affiliate of Tencent.
And Tencent was designated a Chinese military company by the US DoD.
Exactly. And while the immediate impact is limited, it signals a hardening political environment. If the U.S. government decides to force divestiture or sanction these kinds of joint ventures, Roblox could be forced into a really messy, costly exit from China.
Okay, so we have immense success and cash flow, but also these massive risks creating friction. So what are the catalysts that could actually validate this sky-high price?
Well, we have to circle back to the sleeping giant, advertising revenue. As we said, they currently make almost nothing from ads. But that demographic aging up story, that is the entire bull case. You have 150 million daily users. Nearly 70% of engagement hours are from the 13 and older cohort. Brands are noticing.
What's the potential size of that prize?
Morgan Stanley estimates that video and immersive advertising on the platform could be a $3 billion opportunity by 2027. If that materializes, and remember, it carries extremely high margins, it could close that valuation gap very quickly.
And the second catalyst is pure technology generative AI.
Yes. This is a content supply-side miracle for them. Integrating AI tools into Roblox Studio lets creators use simple language prompts to generate complex, interactive 4D objects.
Like a detailed car or a puzzle.
Right. It drastically lowers the barrier to entry for making great content.
And for Roblox, that means?
It floods the platform with higher fidelity, more engaging content at zero marginal cost to them. Better content means higher retention, which drives more Robux consumption. It's a beautiful flywheel.
And finally, they're expanding their addressable market through e-commerce.
Yes, the Shopify partnership is a perfect example. They're blending the virtual and the physical. If your avatar buys digital sneakers in a game, the platform can help you buy the physical pair through Shopify,
moving them into a whole new affiliate revenue stream.
and further validating their appeal to that older spending demographic.
Okay, let's try and summarize the verdict on this really complicated analysis. Roblox is, without a doubt, a category-defining utility. The 70% bookings growth and massive cash flow prove it. It's a brilliant business model.
The business is spectacular. The stock is expensive. That valuation demands flawless execution across advertising, AI, and e-commerce, while also containing that safety tax and navigating the China risk. Our model shows it's significantly overvalued today.
So our final recommendation here is an investment grade of neutral high risk. You should avoid this stock if you are a strict deep value investor. There's no asset protection. But if you're a growth or momentum player, you might hold. But the smart move seems to be waiting for a better entry point, maybe closer to that $56 mark.
Give yourself some margin of safety against that required perfection.
So what does this all mean for you? You now hold the key to understanding this paradox. You know you have to ignore the negative GAAP earnings because the business is flush with cash. But you also have to be ready to believe that the sleeping giant of advertising wakes up fast enough to justify a price that's already assuming 35% cash flow margins.
And here is the ultimate question for you to mull over. If Roblox truly succeeds in becoming an essential social utility for everyone, will the cost of maintaining trust and that permanent safety tax become an accelerating feature of its business? You have to decide if the spectacular growth can outrun the rising cost of civility in a virtual world.
A fascinating and complex dilemma. Thank you for sharing your sources with us for this deep